Morgan Stanley's Adam Jonas is out with a new note today on Tesla, saying it's approaching their $150 bear case scenario. The firm reiterates its overweight rating and raises the question whether there's a value opportunity emerging. It is our call of the day. Jenny, we'll look at you first because we're talking Tesla. And this is a stock that you have some very strong feelings about.
I do. I have strong opinions. So as someone who leans towards value manager, I can get pretty darn creative with calling something a value, right? A value stock. And if we look at what the real idea of value investing is, it's buying something at a discount to the future cash flows, that saying the stock is worth less right now than those future cash flows. I told Dom in the break, and I'm happy that he's letting me say it on air, I think you pretty much need to be on hallucinogenic drugs to make any viable argument that Tesla is a discount right now, or is it as a value stock, or at a great value right now. If you look at Ford and GM, they trade at like 6 times earnings. Even if you look at next year's Tesla's earnings, that's $6 a share. There's no version of this that's value. So if you want to call it a growth stock, and if you want to be super speculative and say, hey, that $6 is going to grow to $60, like, fine, go dream, go get back into the, high atmosphere and the fumes and all of that and call it a growth stock, but you cannot call it a value stock.
So Joe
Terranova, you can't call it a value play.
Okay, that's fair. I mean, Joe, this is not an opinion solely of Jenny's over here. There are a lot of folks out there who don't feel as though, even with a shaving of half its value in the course of the last several months, that it's a value-oriented pick. But I wonder, in the broader sense of Tesla in that consumer discretionary trade, Joe, do we feel as though it's indicative of anything sentiment-wise or direction-wise about the market when it comes to consumer spending and discretionary overall?
Well, first of all, let's understand that Adam Jonas called it a value opportunity. And a value opportunity is not universal to all investors. A value opportunity is specific to an individual, a portfolio, or a strategy. So collectively, from a risk management standpoint, you say to yourself, here's Tesla, a consumer discretionary company that over the last 3 years has had annualized sales growth at 37%. And the other signature tailwind that it had was incredibly strong momentum. Now what has happened? What has happened in the last 3 months is that momentum factor has been decimated. They've lost the momentum factor. All they have is the sales growth. And pushing against that on the other side is that you've got a stronger U.S. dollar and only 44% U.S. revenue growth. You've got a company that, on a valuation basis, currently has a PE somewhere in the mid-50s and a high beta relative to the market. So, all right, you fall back upon, as an individual investor, is this the right characteristic of a company that you could fit into your portfolio? If you could accept the degree of a little bit of a higher beta exposure and a higher valuation, then yeah, it's probably going to be a value opportunity. If not, you're going to look elsewhere within the consumer discretionary space and find opportunities in names like TJX, Walmart, or Ulta Beauty, or even Tractor Supply.
Can I say one more thing real quick on this? I think one of the mistakes that I see people making, not just on Tesla, but across the board right now, and that's why I want to highlight this, is saying it used to be at 300, now it's down 50%. Guess what, guys? It never should have been at 300. Just like Peloton never should have been at 178. And I think one of the most damaging things that we can do as investors is say, because it used to be here, it should be there again. So I think we all need to start fresh with what is it at today, and does it deserve to be there today? So this is just broader, and this is my PSA of the moment. Don't think because it was at 300, it deserved to be there.
Yeah. One last word here.
I agree with Jenny. Yeah, I agree with Jenny, and I said that before, that was the free money multiple. What hasn't been mentioned is competition has arrived. That's always been the bear case on Tesla, and it is there now. It is there from every auto company in the world, and Tesla styles haven't changed since inception. Guess what has changed? All the other cars. So now the sledding gets very tough. There's no capital-intensive company, despite their ROE, that should be selling at this kind of multiple period, particularly with a very distracted CEO who singularly is responsible for driving the workforce so hard to make the moves that they've made in terms of supply chain and production. So I said it a year ago, the best days are behind Tesla. That continues to be true.